first official startup experience and you went all the way till almost the IPO?
I was working in private equity for a fund in Hong Kong, and some friends in LA started this internet services company. The board appointed me CEO 2.5 years, 60 million equity and 10 million from venture debt. It was pretty fast.
What was the hardest part, you making that transition from being an entrepreneur and having to raise funds, but to deploy them instead?
Most entrepreneurs that haven't raised money think, oh, the VC's gone. No. The VC has a job to do, and the VC's job might be even harder than the entrepreneur's job.
Was there something unique about the way you wanted to go about building your fund?
The more customer traction you have, the better. The more product you have, the better. Build up your greed side and try to minimize and mitigate the risk side.
After which it makes sense to start diversifying.
Investors have greed, they have fear. The check comes when greed overcomes fear.
Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality. Today, I'm super excited to be here with San Eng, the founder and president of Skytian Capital. He is someone that has a lot of experience on the multifamily investment side, overall just business, entrepreneurship. He's actually a teacher at Wharton University, an author, has been on I don't know how many podcasts, but a lot of them, and is someone that has a very unique perspective about the intersection of hospitality and real estate, but also the impact that technology and artificial intelligence is going to have on this sector. So, San, very, very excited to have you on. Thank you so much for taking the time. How are you doing today?
Great. Good to see you, Sebastian. Thanks for having me.
Likewise. So, San, let's start with just a quick sort of overview of where you're at today in your career. We're going to get into the story, the journey, how you got to where you are today. But if you could just summarize, everything that you're involved in basically nowadays in a couple of sentences, how would you describe yourself?
Couple of sentences. I think my LinkedIn says investorpreneur. So, been a serial entrepreneur. That's a preneur side. Raising a few $100 million as a CFO, CEO, co-founder, and the investor as a professional investor, VC, private equity, real estate. Another few $100 million, around $700 million deployed as an investor. And now I'm just keep doing what I love. I'm just recently co-founded an AI company, as you know, in the real estate space, and also continue to invest.
Amazing. So, San, can you walk me back to the beginning of your entrepreneurial journey? When did you start your first business? What was that like? And just to get some context on how you got started in entrepreneurship in general.
First business. Phoenix Diet Cookies in junior high school. Have you heard of that?
No.
I'm not sure if they're still around, but actually in junior high school, I signed up for a multi-level marketing campaign. It's a cookie called Phoenix Diet Cookie. You buy the cookies and you sell it to other people. I ended up saving a few $100, ordering a whole, dozen boxes that never sold. And I swear to folks, that's why I'm always perpetually skinny, because that was my meal for many, many years. True story.
Interesting. So that's first business. And when would you say that you had the first business where you actually were living from your business? It was a full-time thing. Like first time you officially called yourself, let's say, an entrepreneur.
Yeah, it's 4.5 years after university. I did strategy consulting, management consulting for about 4 years, and then hopped onto my first startup, which was in internet space. CFO, became CEO, chairman, raised about 70 million when I was 28. Built it into 150 people. Tried to go IPO, went through the whole. Actually, we're going for a dual Hong Kong and NASDAQ listing with Lehman Brothers.
Wow.
we didn't make it. It was during the dot com, right before the dot com, and ended up selling it at a much lower valuation than it could have been. But that was a good fun ride in the
Interesting. So
twenties. Yeah.
basically, first official sort of startup experience, and you went all the way till almost the IPO in that first sort of startup experience of yours. How long was that process of, how long did you stay for that company for?
Um. So I was recruited by some friends. I was working in private equity for a fund in Hong Kong, and then some friends in LA started this internet services company, and they needed somebody to help systematize. It was just like four guys in LA. So joined us to as CFO, and then helped them bring in the first Series A, put together the team, a great board, and then at some point the board appointed me CEO. So I don't know, Series A, B, C, E, F, 2.5 years, 70 million.
Hmm. Hmm. Hmm.
Actually, 60 million equity and 10 million from venture debt. And then brought in a CEO to take over my role, and then became just a board member. So the entire cycle was like 4 years. It was pretty fast.
Okay. Okay.
Yeah.
And if you were to sort of look at that stage of your career, of your life, and try to summarize some of the main learnings or main takeaways or main lessons or principles that you took from those years, what would you say were, some of the best learnings you had in that period of time?
Um, I mean, there's only really one Silicon Valley, though China and some other places have semblances of it. But for the adventurous, and for the ones that want to try to change the world, the tech space, you learn that is pretty addictive. So whether as an entrepreneur or as an investor, so I never really got away from it. Uh, you want to work as a team. The team really matters. In fact, the team is core. You want to go with the tide, not against the tide. So we were 4 or 5 young guys with no experience, but we had a great ambition and great story. And it's pretty insane, a 20 something can raise $70 million with very little experience. So I do think smart people that are ambitious, that have the right timing, can raise money. Uh, I wouldn't say it's easy, but it's not necessarily hard. What's much harder is doing something with that money. And so the lesson from my 20 something, 70 million is we were lacking the right CTO. We didn't have a CTO. So we spent quite a bit of the money on the wrong platform.
Hmm.
Um, and I would say I would bring in also a seasoned COO before I bring in a salesy CEO. We brought in a very salesy CEO, and I'm salesy enough and biz dev enough. I would probably before, and similar as I'm telling my team here with HappiNest, the AI company, I actually am saying I will not support taking in large amounts of money unless I'm comfortable with the team, in particular the CTO, the product team, which we do have right now, pretty good. And then we're now working on a strong ops person that scale businesses. Because if you self-fund it, you raise a few $100,000, it's okay. But if you take 5 million, the speed changes, and you want somebody there that has done it before.
Hmm. Hmm. Hmm.
So
Okay.
so being responsible with the money and doing something with the money is actually harder than raising the money itself.
Hmm.
Not sure if that's surprising to you. At least that's my experience.
Right, right, right. And yeah, you hear a lot of celebration around raising money, but to your point, one thing you hear from seasoned serial entrepreneurs like yourself is that that's where the responsibility begins, right? And that the raising, in and of itself is an accomplishment. Don't get me wrong, but in a way, that's just basically fuel for you to actually go and deliver on your vision. So how has your views on raising capital evolved from that first experience versus, let's say, nowadays with your AI company? You mentioned, of course, having the right team before you go out and raise funds. That makes a lot of sense. What else would you say is different in the way that you look at raising funds today versus when you first started?
um, by the way, I don't teach at Wharton. I went to the Wharton School and I run the alumni club here in Greater Tampa. I do teach a course called investment course called Greed versus Fear.
Hmm.
Um,
MBA, no? MBA level course?
well, the last time I taught it was in Shanghai Jiaotong, which is probably the top school there, and it was taught to Master of Finance MBAs and EMBAs. And so, greed versus fear really applies to all fundraising. Investors have greed, they have fear. The check comes when greed overcomes fear. It's just really that simple, right? Every investment has risk. So as long as greed overwhelmingly is greater than fear, you get that check. Now the equation can be different sizes and the balance could be this depending on the risk level. In multifamily, there's probably less risk versus, let's say, a venture. So the greed has to be a lot more. The return ratio has to be a lot more on a startup versus real estate. But it's basically the same equation. So we that course talks about that is you know, you put yourself from both the buyer, which is the investor's perspective, not just the seller's perspective, which is the entrepreneur.
Hmm.
Then if you can then understand the buyer, the investor, an angel investor has a different checklist than, let's say, a VC versus a buyout firm. There's no dating, no different than dating, right? You're a good-looking guy, and you pick your girl friends or wife based on certain criteria, and vice versa. It's very similar.
Hmm. Hmm. So you want the greed to be higher than the fear. How do you then go about increasing the greed from your investor?
Well, I mean, that's all the things you talk about, right? Right market, right business plan, right team, traction, skin in the game, hopefully more than one co-founder, all those things that add up, right? So
Hmm. Hmm.
it's not one lever, but it's not that many. It's all the same. You got to
Right.
be in the right market, right business model, right team to execute. Um,
So greed
you
is
know,
basically just showing them that there's a lot of upside and showing them that, I guess, other investors are also interested in participating in that upside. Could that be sort of an approach to increase the greed? Because
well,
you're
I
trying to increase the
mean,
greed while decrease the fear, right? From the investor point of view. Sounds like it.
mhm. Yeah, yeah. I mean, it's just obviously the more customer traction you have, the better. The more product you have, the better, right? So it's not one thing. It just really depends on the situational. But that it's just you would try to build up your greed side and try to minimize and mitigate the risk side, right?
Hmm.
So I'm
Hmm.
simplifying it, but essentially it's that formula for any project.
What do you think, San, is the breakthrough that most of your students would get to while following that course of yours about fear versus greed? That you
Yeah,
think,
it's a
yeah.
great question. I I was asked by the dean of the school at the time. His name is Charles. To teach. I'm like, listen, I have no PhD. I've never taught a credit course before, and why do you want me? And he's like, well, the entire roster of professors teaching investing are academics. They've never done it before.
Hmm.
And he was specifically looking for somebody that has invested on the buy side
Hmm.
and also has raised money on the sell side as an entrepreneur. So essentially the whole course is really presenting both faces of it, right?
Hmm.
So that if you're selling your shares, you're raising money, you can't just think about what you're selling. You have to really think about what they're buying and why they're buying, what the concerns are, right?
Hmm.
And similarly, most entrepreneurs that haven't raised money think, oh, well, I'm a VC, I have $100 million. The VC's God. No, no. The VC has a job to do, and the VC's job might be even harder than the entrepreneur's job because he has investment committee, he has returns hurdles, and so he has to go and find that right investment. And often, after seeing 100 deals, that one deal, that handsome Sebastian Munoz that he says has that potential, is probably seen by 10 other VCs. So you see? So then why should Sebastian pick me over the 9 other VCs, of which maybe half of those might be even more branded and more substantial? So actually so then Sebastian, the investor, needs to start thinking as the entrepreneur as well, right?
Mm-hmm. Mm-hmm.
Because why would I take, if I have 10 term sheets, why would I take yours if you're not as famous as somebody from Sequoia? If you're not Reid Hoffman? Well, you might need to get into some psychology. Maybe San needs something that the other guys are not offering, right? It's really, it's both sides. It's very, right? It's getting to know the customer. Yeah.
So understanding what are their needs and what is it that they're trying to optimize for.
It sells, right? It sells, but it's not as stereotypical as, oh, I'm rating 100 million. Well, I have the best job in the world. No. Every fund has fiduciary duties. They have partners. They have investment committee. They have investors that require certain returns. The fund has a certain strategy where they can invest or not invest. And then they have to make returns. And again, most of the time, if you find a good investment, so has 5 other VCs. Right? So then it becomes a competition. Yeah. It's not easy on either side. So if you're fundraising, you want to make it super easy, because that partner of the fund has to slice through probably 100 deals before you invest in one. So if the other 99 deals present everything in such a way that makes it so that the partner can make a decision in 1 hour, because all the information is there, versus, well, he has to spend a day looking through data. Well, he doesn't have a day. He might just reject you right away. Right? Yeah. So, I mean, I think it's pretty commonsensical, right?
Makes sense. Very interesting. Now, San, tell me, when you were done with your involvement in this internet startup that you mentioned, what was the transition point from there into what came next?
I brought on, at my board's advice, I was 28. We had 70 million in the bank. It was 150 people. At 150, you start not remembering the names of the staff. And human culture teaches you the magic number is 150. That's when the, let's say, a chimpanzee tribe breaks down. And similarly, the entrepreneur that takes it to a certain size, typically from a staffing standpoint, 150, isn't the right entrepreneur to systematize. So my board advised me to bring in somebody professional. So we recruited the head of global practice for BCG, for telecoms, to be our CEO. And then I became a board, and essentially I moved to China because I wasn't running the business anymore. And then I started my first fund out of Shanghai.
And can you just walk me through, the timeline in terms of, do you take some time for yourself and think about what's next? Did you already know that's what you wanted to do next, starting your own fund? Or
No. I just decided to move to Shanghai. In fact, I didn't know what to do, so I signed up for an MBA course. I was going to just spend 2 years there. Ended up spending 17 years there, and after a while, I got bored. Met some classmates, and then decided to do one of the first China private equity funds.
Okay. Now, when you decided that this is what you wanted to do next, what was the vision, right? What is it that you wanted to go after from a industry perspective, or was there something that you had sort of unique about the way you wanted to go about building your fund?
Good question. So this was in the early 2000s, so we already had venture capital. So Silicon Valley firms, Sequoia, Redpoint, DCM, they were already well entrenched in China. And then the big buyout guys already there. So I found a niche in early growth. This is not necessarily tech. It could be tech, but it's not tech. These are just companies that might have been around for 10, 20 years. Um, and they have EBITDA. We typically look for post revenues with cash flow. They just can't scale up, and they're almost always Chinese companies, and they may not even speak English, but their product or service might have international expansion potential. So I raised the first what's called a Sino-Foreign joint venture fund. It's a combination of a Chinese RMB and US dollar commingle, because at the time the currency was very restricted coming in and out. So we actually created one of the first joint venture currency funds, and the idea was we would focus on this early growth, post product, EBITDA positive companies, and then help them to expand internationally. It took about 18 months to raise. We set up to raise 50. We ended up raising 100, fund one, and we deployed it, and then we set up to raise fund two, which had commitments for 450. But before I finished raising that fund, I left China for some health reasons related to my kids, and so I didn't stay on for fund two.
Interesting. Now, what was the hardest part from you making that transition, from being an entrepreneur and being on the racing side to now going into the side of the fund and having to, well, also raise funds, but to deploy them instead? What was the hardest part about that transition?
I mean, I think every venture is hard, right? So I don't really think, I never really thought
Or
what was
maybe not the hardest, but what was the thing that was different from what you were expecting?
Yeah, I mean, it's just finding product market fit, like anything. So, I mean, I'm not a Sequoia, so I can't be like, I'm going to go raise a venture capital fund to compete against Sequoia. I was Western educated. I'm Chinese, so I have that, which the local Chinese don't have. I have connections in China through my business school. In fact, my first Chinese investor, LP, was one of the largest financial services institutions, Chinese, and the chairman was a classmate of mine, so he backed me. But then he's like saying, to close this fund, it's a cross-border fund. For him to get his approval to invest in my fund, it's like 100 million RMB, $50 million. He wants a branded foreign player, and so I went and raised money from European family offices. We had the largest shareholder, BMW, commit 25 million. We have the largest, the wealthiest Swiss family called Schmidt-Heine. They own Wholesome Cement and Cemex. I think Cemex, Wholesome Cement. Then those guys are saying, well, it's a cross-border fund. We need a strategic Chinese player. So then it's a matter of chicken and egg, right? So I told the Chinese guys I got the Western side. I told the Western guys I got a Chinese side. you do a simultaneous close and you have both. And then once we have the Chinese and the Western, we have the Koreans jump in, because the Koreans are trying to get into China as well. So we brought in 15 million from Mirai Asset, which is probably the most aggressive entrepreneurial financial service group. They're like a Citicorp out of Korea. So they put it in as well. So then you have the Chinese side, you have the Chinese guanxi, you have the Western side. So it's just kind of making it fit, because investors wanted a certain product and a certain background. So they know that I can execute, but they like the Western guys said, well, Sand's just Sand, but there's a major Chinese player, right? And the major Chinese player, you have some of the top European players. And yeah, this is legit. Just kind of packaging it. It sells, right?
Interesting. Now, would you say that it is sort of the norm and common to have the results you had as a first time fund manager, or would you say that what you achieved there, as far as what you managed to raise and whatnot, was somewhat of a surprise to you in terms of what you achieved? Like, is it something that you were sort of, that's what you were hoping, that's what you were aiming for, in terms of what you ended up raising? Did you exceed those expectations? You said you were going for 50, ended up with 100, I believe. So
Um,
uh, like, I'm just basically, what I'm trying to get to is, what was it, right, that you think made that success possible, especially when you're saying that this was your first fund? Was it like, were some of your partners, were there more seasoned, as far as like they had done the fund thing before, or was it just the vision was so good,
no,
the
no.
background? What was it?
Um, I mean, I don't think there's surprises, Sebastian. It's just having a goal, and then, I mean, I didn't expect it to take 18 months. I almost gave up. I could have given up, right? Um, so I don't think it's surprising. You just go for it. And then there's weaknesses, right? So first time fundraiser, I didn't have partners. The partners came in after the funds were raised,
Okay.
but I was able to, for example, attract a chairman who's quite famous. He's a Brit. He His name is Simon Moret. He's a French Legionnaire. He has a movie made after him. He became one of the most high-ranking foreign CEOs of a Hong Kong listed company for Li Ka-shing. So I convinced Simon to be my chairman, and Simon is a known entity with the Europeans, so they don't necessarily trust me, but they trust Simon, and Simon trusts me. And then Simon's famous enough that um, if he came with me to meet my LPs in China, I might get the CEO of the financial group. If Simon came, he gets the mayor, he gets the party secretary, he gets the governor. And so if I'm fundraising, Simon shows up for a banquet, then the investor is the financial group, and the party secretary, the governor of the province, shows up. Well, there's a much higher likelihood that the check is written. So you just kind of build around it, right?
So it comes down to people once again. Earlier we were talking about, you were talking about the importance of having the right C-suite before going and racing. Now you're talking about, you might be the one putting together the fund. Who you bring on is also as important, right, as far as the people goes.
Yeah, I mean, always, right? Yeah,
Got it.
absolutely. Hmm.
Got it. Now, San, you mentioned that you had to leave China for Fund 2. And what did you do afterwards? What was next for you? What
I
came
took
after
five
this?
years off. So I left China at 45, and I didn't have any staffing or P&L responsibility for 5 years until I was 50. So I wrote a book with my dad. I wrote a book with my daughter. I spent 3 years conferencing blockchain crypto conferences trying to understand crypto, and I didn't get it. I did a bunch of deals. I ended up becoming jaded. I wasn't smart enough to get it. And then I transitioned to real estate. But for 5 years, I didn't really have like any responsibilities per se. I was doing stuff, but I was more coasting by a little bit, learning. That was fun. And spend
Can
a lot
you
of
can
time
you
with my.
tell Yeah, can you tell us about those books, by the way? Those books, which one came first, and what was uh
I helped my
what was the
dad
reason
write.
behind
I
writing
helped
them?
my dad write his biography. So it's published, but it's only for my family. So it's a Chinese English book about his and the Eng family. And then during COVID, more recently, I wrote and published a book with my daughter, who was a senior in high school, and my nephew, who is a senior in university. And it's called The 10 Commandments of Investing, and it actually did pretty well. It made Wall Street and USA Today bestseller.
Hmm.
And we're writing a sequel to that book right now called 10 Commandments to Generational Wealth.
Interesting.
Yeah,
So I
targeting
want
New
to
York Times bestseller.
love it. I want to tackle each of those two books. So let's start with the biography of your dad. What was the biggest lesson or principle that your dad passed along to you?
Um, well, it's my dad's book, but it talks about the whole family. I mean, it was actually just convincing them to do it because they're just so humble, right? So just through a bit of time, just getting the stories and getting it on paper. We have a massive family that are in different parts of the world. I'm what's called Hakka Chinese. Hakka Chinese are the ones that travel all, like you typically find Hakka Chinese in Jamaica, in Malaysia, in Indonesia. We're that specific culture of Chinese that travel a lot and are adventurous. And so we're diaspora all over the world. So we just wanted to capture all that because my kids don't know that story. And so
Mhm.
it's bilingual and they read the book and they have a good idea where the family came from. My dad's grandpa actually came during the railroads to help build the railroad. Actually, he came at the tail end, and then we connected to California, and the Chinese Exclusion Act came, which forbids Chinese from staying. And so many Chinese went to Mexico, to South America. As you may know, there's Chinatowns in Mexico. And then my grandpa came to the East Coast and helped start the first Chinatowns in Newark and Boston and New York. But I came later with my dad, so I'm first gen. So it's important to document all that stuff. The Chinese have been here as long as anybody else. Yeah.
And in terms of anything that you would attribute to your dad from a lesson or principle or sort of something that he would have taught you that you think has served you well in life.
Yeah, I think it's same with most immigrants. Sure, same as you and your parents. It's not just Asian. It's just appreciate America, education, right, and hard work, right.
Mhm.
That's the same formula. And I actually enjoy working with immigrants because immigrants tend to have that gratitude, whereas not all, but folks that have been here longer tend to complain about America.
Mhm.
Right?
Mhm.
They
Yeah.
see the dark side, and the entrepreneurs and immigrants see the positive side.
Right.
America has a lot to offer.
Oh yeah. Yeah.
That's
Yeah.
why
Yeah.
you're
No.
here and I'm here. Yeah.
Yeah. Yeah. Yeah. No. I can totally agree with the perspective there when you've seen it from the outside and you know what it represents to even make it. To a country like the US, in my case in Canada and whatnot, and just being able to be part of that, something that you definitely feel very grateful about. So interesting that was also a lesson. Now, what about the other book, the one about the 10 commandments of investing? um,
Um.
Perhaps without going through them all, what would you say would be the most important principle in that book, if you let's say could not show that book to your kids, they would not have co-written it with
Yeah.
you, what would
It
you?
has an interesting backstory. So my brother Edmund is investment banker, and he's ex Morgan Stanley Columbia. He ultimately became CEO of a public company in the Hang Seng in Hong Kong that's investment bank. And I was in China running my VCP fund. So he and I ended up just meeting some crazy, crazy smart people. And we read a lot of books. So over the course of 12 years, we started summarizing people that we met, books that we
Mhm.
read, into 2 or 3 pages, essentially cliff notes of super smart investors.
Okay.
And then we basically collated that, his and mine, and we called it initially the Investor's Bible. It was basically a bunch of cliff notes. We found a publisher, and during COVID, we were going to publish it. And then during COVID, we were all in lockdown. So his son, Timmy, who's a senior at Columbia at the time, and my daughter, who's a senior in high school at the time, like, read the book for us. Tell us what you think. And they both said, oh, this book sucks. It's a great content, but it's so thick and technical, nobody would buy it. So we challenged them. We said, okay, well, you're locked down. Why don't you write the book for us? So we ended up spending 6, 8, 9 months rewriting the entire book. And the instead of a bunch of summaries from Buffett or whoever, we said, whether you invest in real estate, blockchain, or venture, what were the themes that tied all together. Does that make
Mhm.
sense? And we basically discovered that it was whether you're Buffett or you're a Sam Zell or anybody super successful, you follow these 10 commandments like the Bible.
Mhm.
So all 10 commandments are important. We won't kind of go through it. You can buy the book. The book goes to charity. The proceeds go to charity, and essentially it's the 10 commandments as practiced by all the investment wizards we study globally. And those are the strategies to follow. Right? So again, it could be short-term rentals, it could be long-term rentals. It doesn't really matter. And then again, that did pretty well. What my nephew and my daughter did was they added a lot of anecdotes and stories. And they made it fun. They added some visuals. It used to be all just a bunch of old white men that we summarized. They added some folks from overseas, some famous woman investors. So it's a lot more representative. And again, it did well. And so we're now doing the sequel to that book.
And if, without going through the 10 of them, but if you could share one of them with us, one that you think is particularly important or perhaps central to your own success, what would you say that is?
I think the most controversial one is Commandment 6, which is diversification. So if you go to business school, and I'm overqualified, I've been to too many business schools and taught at business schools, they always teach you about portfolio diversification. If you're investing in stocks, buy 40 or 50. If you're doing venture, uh, do 40, 50 deals. I'm not debunking that, but if you talk to Buffett, you talk to Mark Cuban, um, you talk to Elon, um, they don't have 40, 50 stocks. They actually have a pretty high concentration of companies they know really, really well.
Hmm.
So, so, um, Buffett, I think Buffett among us said, you basically can over diversify to the averages, right? So if you have 200, just buy the index. And so we think that's true. Commandment 6 is diversify, don't over diversify. It's not that intuitive because in business school they teach you to over diversify. But I think the most successful investors like Buffett, and if you look at Elon, he basically has maybe a handful, 6 or 7 companies, but he knows them really, really well, and he right, and so he's running, but he's also investing.
Hmm.
And Buffett, same thing. He buys Coca-Cola, he buys Apple, he keeps it. He understands it. He
Hmm.
doesn't have
Hmm.
like 200 companies. Yeah. So that one
Got
was
it.
the most controversial because it's like, well, what is that magic number? Right. So I think in real estate and private equity, the magic number is probably 5 to 15. It's not 50. In early stage venture, you might need to do more. But if you're running a public equities fund, you don't necessarily need 200 stocks.
Hmm.
I would
Hmm.
prefer the Berkshire model more. So again, it's not universal, but I think our research shows diversify, don't over diversify.
Interesting. And I don't know if it's Warren who said this too, but it's like, you hear don't put all of your eggs in one basket. But I think it's him who said, well, put it in one basket, but watch the basket. Make sure you watch the basket.
I think, yeah, yeah, yeah.
That's interesting. And would you say that, let's say from a personal investing point of view, because again, to your point, a lot of these people you just mentioned made their wealth in doing one thing, but doing that one thing very well, very very obsessively and whatnot. And then I guess once they had wealth, then they could get into diversifying, right? Somewhat, somehow. So would you suggest that, as a, now your second book is going to be on wealth creation? Would you suggest that as a wealth creation strategy, like, first go all in on one thing, and then once you've built wealth through that one thing that you went all in on, now you can start looking into diversifying? And if so, what would you say that, what's the point after which it makes sense to start diversifying? Is there a threshold after which you would say, now you've got
Mm.
enough where it makes sense to start diversifying? Until you get there, don't even think about diversifying, just think about doubling down on what you have going on.
I think it's an important question. I don't know. I have an answer for that. I think it's so situational and personal. I just decided early on. I graduated from a decent school, and I worked for a couple of large companies. I hated it. I just decided when I was in my 20s that I just want to do my own thing, and I don't do ventures thinking to make how much money. I just do ventures thinking, am I going to have fun doing this venture? And then, then they should, everything else should follow.
Mhm.
Um, then depending on how busy you want to be, I'm recently, all my kids are now going to college. Um, I'm, I have time. So I'm taking on a bit more these days
Mhm.
than I did 5 years ago. I was spending a lot more time with my kids, right?
Mhm.
So yeah, I think it's very personal.
Very personal.
Uh,
Okay.
uh,
Now, what about in your personal case, right? What happened after those 5 years where you wrote those books and spent some time with your family and whatnot? Was real estate the next thing, or what came after?
um, yeah, I mean, during COVID, I was living in Toronto, and it was locked down. I couldn't stand it, so I got into a car. I'm a pure Tesla guy, so drove down to New York. New York was locked down, and I couldn't stand that. And I drove down to Florida. Florida was not locked down. Looked at a lot of markets. Drove all the way to Texas and back a couple of times, including with one of my daughters, and then just started investing because you get to know the market. And so it's about over a year of driving. I think I probably put in 65, 70,000 miles because there's nothing else. I couldn't fly. There was nothing go. And so that really got me to learn the market pretty well. Just real estate pretty local. Yeah.
Hmm.
And then got into the space. So since then, acquired just about 100 million of assets of multifamily, and then invested another couple of thousand as a passive, about 20 projects. And so it's a pretty accelerated for somebody that went in with almost no experience.
Hmm.
Yeah.
Hmm. What would you say is the, I don't want to say secret, but the approach you take to go into a space that's new to you and learn it and become good at it relatively fast? Because you did it when first
Yeah.
on
Yeah.
the startup world,
Um,
then you were on fund, then real
yeah.
estate.
Well, if you did management strategy consulting, you will learn that you can become an industry expert in 3 months if you deep
Hmm.
dive, right? So if you assign me to Malaysian mobile phone business, or you assign me to the Chinese tire business, which truck tire business, or anything, I'm sure that if I commit myself 2 to 3 months and deep dive and talk to experts, read up books, I can know more about that space than 99.99% of the world. And in many cases, I can know more about that space than the client. So, for example, Pacific Tire, which is an Australian tire company, hired my firm to consult them on the Chinese tire market. They may be the Australia's famous tire company, but they know nothing about China. In 2 months, 3 months, I could teach them about China, right? So it's not hard. So younger days is just deep diving. I'm still deep diving, but as I got older, time is more precious. I just pay for it. I paid, for example, in multifamily, I paid over 4 years, anywhere from 30,000, 35,000 a year to 100 grand a year to be in part of a mastermind, to be with people that are much more successful in that space. And then you then purchase time with them, right?
Hmm.
In the $100,000 category, you meet at a 5-star resort 4 times a year, and you're eating with them, you're singing with them, you're drinking with them, and you become friends with people that own 20,000 units,
Hmm.
right? And the lawyers and whatever and the investors are there. So I now just pay for mentorship. Similarly, in the happiness case, where we're doing AI prop tech, we're not necessarily uh, we're paying for service in the sense that we're allowing certain people, clients, advisors, to actually come in for some shares.
Hmm.
We're actually allowing some of them to invest as well. Does that make sense?
Hmm.
So So it goes both ways, right?
Got it. Got it. Got it. That's interesting. Yeah. So basically, shortening the learning curve, right? By bringing in people that are far ahead.
Smarter than
That
you,
makes a lot
smarter
of
than you.
sense.
Yeah,
That
yeah,
makes a lot of sense.
yeah.
Which is by the way why I love having people like you in here on the show, because
And that's
it's such
why
a
I write the book.
learning
We do
opportunity.
interviews too. Yeah, we're doing 100 interviews for the second book.
Okay, interesting,
Yeah,
interesting. Now, San, so you get into real estate uh, originally on the multifamily side, and when do you discover, if we could call that a discovery, the hospitality or vacation rental, short-term
yeah.
rental side of it?
So, um, my belief is if you look at the short term space, if you look at what's happening in Seattle, Toronto, I'm not sure about Montreal, but New York, um, it's not surprising that there's going to be crackdowns and regulations. So in the case of my Toronto condo, we did really well using a third party PM, renting out short term 365 days out of the year. About 2 years ago, they made it 6 months max.
Hmm.
So that PM doesn't really know how to do midterm or long term, right? So basically, my income slashed by half. So I think there's that's a lot of regulations in other cities. There'll be more. So I think STR operators need to learn the channels and the systems and the technology and the software and the marketing to do flex leasing, what I'm calling flex leasing.
Hmm.
On the long term side, multifamily, um, you're getting hammered now by labor costs, insurance, taxes, interest rates. So for certain assets that are well situated and well zoned, you could turn the long term leases into furnished corporate leases or short term leases. So at least in my multifamily group, we're seeing a lot of interest. The issue is 100% of long term property managers I've met and used, 100% do not know how to do short term. They don't want to touch it, and vice versa. Okay. So you're seeing some, and it's for good reason, because it's extremely difficult to do short term versus long term, right? It's extremely difficult
Hmm.
because you have different channels and different softwares, different systems, and you got to deal with seasonality, different pricing plans, stuff like that. But we're seeing some venture capital follow software companies and or PMs that can do flex leasing, and because then you can, if you do it correctly, you can potentially help um, maximize value for the tenants, for the property manager, as well as the owners. I'll give you an example. We're trying to pioneer a long-term and short-term arbitrage here, and we're trying to figure this out details-wise. So we have a 50-unit asset in downtown St. Pete. It's in downtown. We're grandfathered to do short-term, mid-term, long-term, hotel, industrial. What do we want, right? And however, if we have even one unit on short-term, my insurance costs go up dramatically because the insurers might not even take you because they only want to do long-term. Same with the lenders. Follow me, right? So what we're looking to do is rent these out 100% as long-term, correct? Right? And then I get my cheap insurance, I get my better loan. And what we're going to try to do, and what we're executing legally, is to allow the long-term tenant. It could be a doctor from Ohio that's only in Florida for 3 months out of the year, wants a Florida residency, needs a 12-month lease, right? Uh, and then we then allow and we then sublet out at the unit level when he's not here on short term.
Hmm. Hmm.
So think about the, now if you can execute this, there's obviously some accounting legal issues. As the PM, if I'm a flex leasing PM, as a PM, I charge that tenant I charge the owner a property management fee, right?
Hmm.
For onboarding that long term tenant. The owner's happy because I can take that long term tenant and show it to lenders and insurers, and I'm a stabilized long term asset.
Hmm.
Um, Now the PM charges that long term fee, and then if the tenant decides to do short term, let's say in the 6, 12 months, 9 months he's not here, you can charge an STR fee, right?
Hmm.
The property manager makes more money, making money twice.
Hmm.
Now the tenant is happy because if he were to rent a $2,000 studio from a condo, the condo will prohibit flex leasing. So you got to be in an asset where it's allowed. But the tenant is now more willing to pay a higher rent or sign the lease faster because he's not thinking I'm out 2,000 times 12 months. He's thinking I'm down 2,000 6 months. The other 6 months I could potentially make money to cover or maybe exceed the actual long-term rental. So if you can operate this crazy model, it's a win-win-win. We're pioneering that right now.
And Sean, I know we talked about this off camera as well, but why do you prefer that approach versus the approach of basically just leasing all the units long term as a company, so company corporate lease, and then just subleasing it as short term all the time?
Well, you have to find a corporate lease.
But let's say the corporate lease is like you have your own separate entity that just rents the units long term.
Well, if you have 100 units and the owner rents 100, you're not going to get a loan unless the 100 units is by Microsoft.
Okay. Right. So basically,
and why would I take that risk? I don't need to. I don't want to take that financial risk, right? As an owner, I want 100 long-term leases for diversification of income, right? And safety, and that's what the lender wants, and that's what the insurer wants, right? But you have tenants that might not sign a deal with you if they're only here for 6 months out of the year, unless you allow subletting and allow for. But then if they're, I mean, we had an inquiry recently from a guy in Connecticut. He owns a boating business in St. Pete Pier, and he was sick of renting B&B each time. So he's here 2 weeks each month. So we didn't sign that lease for, I think, personal issues on his side, but he was like, oh, this is really interesting. I want to sign a 2-year lease with you, establish residency. And then every 2 weeks, I want you to put this on Airbnb. Right?
Right. So it really becomes about being very targeted in who you bring on as tenants, because you want tenants that are not going to want to be there.
It doesn't have to be that. It could also be you've got 150 units and you just want diversity of income, and you could put 120 as standard, and then the 30 units you may choose to furnish it and do flex leasing, right? Corporate leases or whatever it is. However, if your current manager is long-term, that current manager almost always will not accept the flex leasing because they just don't know how to do it. And the channels are different. The marketing is different. You know that. What you do is very different than what a long-term person does, right? So will that long-term property manager engage you and lose the 30 units? The answer is no. Right? So there's some value. Wow, massive storm.
Wow, that was loud.
There's some value if there's a capabilities to do both. And we have a client, the AI company that does property management services. We have a client that manages 1,200 units long term. They're a property management company, so they're not owners. And they have owners that want to buy more, or they have owners that own assets that they're managing long term, but these assets are in short term neighborhoods that are zoned for short term. And the owners are saying, we're not making enough money long term. I want you to turn these into short term. And that PM does not know how to do it. They don't want to do it. So we may take these guys on. It's about 40 units in Tampa. And we'll basically negotiate a PM agreement with that owner. The current PM and long term will take a split of the profit of the fees. They will do the proper repairs and maintenance, on-site work. We will handle all the digital stuff like what you guys do. We'll bring in the cleaners, and then we'll just be partner up. And I can tell you this client, this PM, long-term PM, is very happy because he says, oh, if we figure this out, that investor wants to buy a lot more. And he makes money on the buy-sell. he makes more money in the buy sell than he does on the long term PM. So he's comfortable. He wants to serve his client better, the investor, but he doesn't want to take on what you do.
Can you tell us about HappiNest AI? How does that come about? What is it? What is it that you guys are doing, and why did you decide to start this company?
We started it purely out of desperation. So again, in past years, we bought about 100 million as a GP in multi, some small, some big. And then we invested passively in another 2,000-3,000 doors. And so another 20 deals or so, 10 GP, 10 LP. And the deals that didn't do well, not the only reason, but a large reason is because of property management. And so in one of the assets where actually in two of the assets, we had a third PM, and in one asset, we had a fourth PM. The fourth PM, basically, we got so desperate, essentially, is what became HappiNest. Is we started, it's a small, like 50-unit asset in St. Pete. We couldn't afford a full-time PM. It's too small. But this is long-term. Actually, this is flex leasing. It was just too small. We don't have the budget to hire a decent, competent manager. So we started using virtual assistants overseas to do certain things like marketing, lead gen, lead qualification. Then we started using AI to replace or automate some of that services over a few years. And then we found that it worked pretty well. It was a lot cheaper. And then my partners and investors say, "Oh, that's interesting. Can we buy the service?" And so it became a company. And so HappiNest now is developing a suite of revenues, what we call revenues rocket services, using AI to power branding, lead gen, lead qualifications, even setting up tours, virtual tours. And this month we onboarded a $1 billion AUM client out of Los Angeles. And then we onboarded the largest PM company in St. Pete as clients to use these services. And we have a large waiting list. We're just trying to get the product to a better, more automated stage.
And this is for long-term property management companies. How does that tie into the flex leasing?
Yeah, our focus is this revenues rocket, which helps any asset. So let's say you own a 30 units, a branded boutique Airbnb. If you want to build that, let's call it Sebastian's Montreal Resort. If you want to build that and create content to build content around that, most long-term PMs don't know how to do content, and they would then insist that you hire a third-party digital agency, which charges $3,000, $5,000, $10,000 a month, as you know. We've automated that, and currently we have clients paying $1,000 to $3,000 a month to get a lot more output because we automate it. But our next version, for same or better output, we're going to charge $100 because we're automating it and making it what's called PLG, product-led growth. And that's going to come later this year. And so we'll be able to give you 1 or 2 decent social media posts created doing some kind of automation after a setup. Get that through a number of social media channels, track it, and automate a newsletter out of it.
So you basically feed the system with information about the asset, the property, and the system will take that and convert it into organic social media posts.
So we're semi-automated now with virtual assistants to help QC, but it's so cheap now that even at $100, $200 for 1 or 2 posts, decent posts a day, we can make money. But we have clients paying 4 figures a month right now. And when we told these clients that, hey, we're going to give you the same thing, but less in a few months for $100, we're like, bring it on. Then the second product is in the long-term space, just like in the short-term space, you can't replace Airbnb. We can't replace Zillow. So the long-term PMs will be using internet listing sites like Zillow. However, if you buy 2,000, 3,000 of Zillow Premium or apartment.com, they syndicate to like 10, 20 sites. The leads coming through all times of the day, all different channels, even in emails in different format. In the long-term space, there isn't a good product that integrates all the leads into one place. We built a dashboard that if channel A comes with an email with a lead's name, 2-bedroom budget in whatever format, and channel B comes in a different format, our AI scrapes everything and then can then immediately respond in whatever language, in whatever channel, SMS. We don't have voice now, but we'll have voice soon too. SMS, Facebook, WhatsApp. It will basically qualify the bot. It will qualify the lead. The VAs 7 days a day would QC it, and then the qualified leads would then just fill out a form, or would then be bounced to a live agent, a live person. So that's live. And then we have a suite of proprietary smart devices, smart locks, smart cams, smart Wi-Fi, private Wi-Fi, that's enabled to do virtual tours as well to complement, let's say, the leasing person who might not be able to make it on the weekend or during holidays. We actually have overseas agents call in on Zoom while the prospect walks the units, the qualified prospect. And we've signed a lot of leases that way. So that's our first product suite called Revenues Rocket. We're going to version 2. It works really well. Separately, we have another company that is testing different software, third party for now, that essentially can use AI to do guest services. And we're developing a small team or a partnership, I think I mentioned to you, to do STR, because we have LTR clients that want STR. Mm-hmm. And so whether it's through a partnership or through building a small team, we're going to service that client.
And what's your vision? Where do you see this company when you look ahead? I mean, what is it that you see right at this stage? Where
HappiNest. Okay, in the future, this is a little crazy. Okay, so Econ 101 says an economy, simplistically, is capital plus labor. Right? Capital plus labor. It is our belief that in a not too distant future, mental AI plus physical AI is basically mental AI embodied in a humanoid robot with humanoid hands, like Optimus, like Figure 8, like Unitree. It is our belief that mental and physical AI can and will displace almost the entire property management services space. So I'll give you an example. There's no need to have so many humans involved in rent collection, right? There's no need to have humans involved in guest services on Airbnb, because most of the questions are FAQs. The FAQs are dumb, but an AI studying the FAQs will become smarter and more consistent than a human, right? Same with lead generation, lead qualification, all of that can and should be handled by AI. If not 100%, certainly 70%, 80%, right? Because AI gets smarter. So eventually a lot of that will be handled by agentic agents on the services side. On the physical side, if you imagine a Tesla Model 3 running FSD 12.5, can go 80 miles on the highway during the rain and spot a deer and avoid a deer. How hard is it to make a Model 3 is maybe like 30,000 right now. How hard is it to make a humanoid robot, which uses a lot less metal, right? The same FSD software, the same Dojo supercomputer, for 20,000, 15,000. And how hard is it to imagine if that robot had the same brains with the spatial recognition and same fingers as you and me to walk around the community, a private community of apartments, and recognize a beer can and pick it up and put it in a trash can? The answer is it's not hard. It's actually a lot easier. It's easier to go 3 to 5 miles walking, recognize garbage, put it in the garbage can, to then use the same hands to cut a tree, operate a lawnmower. It's a lot easier from a technology standpoint, physics standpoint, and a lot easier from a regulation standpoint because it's not going 80 miles an hour.
Mm-hmm.
So humanoid robots will actually deploy in many cases in private situations like apartment communities. We think faster than autonomous cars because of regulations.
Mm-hmm.
So I can imagine a humanoid robot can take over. Like for example, Amazon driver comes out to your condo building, 200 boxes. Do you really need the Amazon guy to deliver the boxes to Unit 506?
Mm-hmm.
There's barcodes. Robot scans the barcode. It has the fob. It goes in, takes the elevator, goes to 506. The robot costs $15,000. It can work 24/7 with a 2-hour charge. Is it crazy? We see that future. We're a young company and we're obviously focused on mental AI or property management, but we want to raise enough money and build enough teams so that we start building software that can go into a figure 8, a unit 3 from China. Unit 3 from China is being produced right now at $16,000 retail price. And you want to then build, you can basically create an app that goes into a unit 3 figure 8, an Optimus, and say, I'm going to train you now to walk around. I have an asset in South Tampa, 13 buildings, 135 units across like 2 blocks. It's a lot of work picking up garbage. Listen, go on training mode and just follow me around. And this is a Coke can, this is a beer can. You train this thing and it can do it, and it'll double as a security guard. I don't see this as 10 years away. I see this as sooner than 10 years.
Wow, that's impressive.
And think about the economics, right? It's probably around 65,000 all in to have a handyman / maintenance guy. I would pay 200 grand for a human robot to work 4 shifts instead.
Mm-hmm.
Wouldn't you? It makes more sense, right? No lawsuits, no complaints, and willing to work in dangerous situations in C-class neighborhoods. Double as
That's
a security.
interesting because you don't necessarily have to build the hardware. You just you get the hardware or the device or the humanoid or however,
Hardware
and then
will be
you build the software component and you just build it with this particular use case in mind, specifically around things that
well.
help on the real.
If there's a billion apps, I don't know. If there's 10 billion apps in the iPhone App Store, there's going to be 100 billion apps for a humanoid store. So our goal is to build the top apps in property management situations, and then we will rent out the robots as a service, labor as a service.
Wow.
This is getting a little too crazy, right? This is we can.
I mean, no,
That's
this is where I wanted to get to. I wanted to know what the vision was. What you were looking at
um
when you looked ahead, and
the vision for Happy is we interact on the social, we interact on Zillow prospects, we interact with the tenants. We will eventually ingest all the acquisition data, amenities data into a what we call PAD, a private asset database. Think of this as the data brain of a, let's say, multifamily building, a single family building. But it's going to become much, much easier. You can then, if you play with custom GPTs, let's say I'm the owner of the 50 units, and let's say all the data is fed into this PAD. It is very easy to build a software so that I can custom make my own agents for whatever use case I want. So I can enable an agent for my CFO to create certain reports in a certain formats because the data connects to the financial system. I could have the tenant custom create a reporting function where the tenant can ask about expiration date or lease renewal pricing, whether or not utilities included, just by having the bot dig into the lease database. Why do you need to involve a property manager?
mm-hmm.
You don't. The bot can do a better job, right? The agent can do a better job.
Wow.
So the long-term vision is really mental physical AI, and then ultimately the data into every building should have a PAD, every asset.
Mm-hmm.
So that at some point when Happy is managing, let's say 1,000 assets in St. Pete, there's 1,000 PADs. And in the course of creating those PADs, we have screened, let's say, 100,000, 500,000 prospects from Zillow. Do I still need Zillow? Interesting, right? And if we have 1,000 properties that have the rental data trends, and it's all in the system, do you still need CoStar?
So there's an
Oh, it's
eventual maybe vertical integration there that
I don't know. I mean,
we
it's
haven't.
a dream. It's a dream. You have to get there, but you got to start somewhere.
Wow, that's definitely impressive. San, I know you have a meeting coming up ahead. I appreciate your time. I appreciate how generous you've been with your insights. I could stay here for another 2 hours, believe me, because this has been super helpful, insightful, interesting, eye opening, and the list goes on and on, inspiring. So thank you so much for sharing your time and wisdom, and
Thank you.
we'll stay in touch.
Okay, Sebastian. Have a great day.
Thank you so much.